People are losing properties, quietly, legally, and often without realizing it until the penalties arrive. Across the United Kingdom, a sweeping set of housing reforms is rewriting the rules of the private rental market. Thousands of landlords are discovering the consequences only after the fines appear. In this investigation, we examined government legislation, regulatory announcements, tax policy changes, and housing market data tied to the UK's private rental sector. What we found is a system that is changing fast, and not always in ways property owners expect. At the centre of it all are 7 regulatory and financial shifts that could reshape the rental market over the next decade. This is the housing truth they don't want you to hear. Start with the Renters' Rights Act. For decades, private landlords across Britain operated under a relatively familiar framework. You bought a property, you rented it out, you followed tenancy rules. That was the understanding. Millions of property investors trusted that system. But here's what the legislation changed. Under the new framework, landlords can now face administrative penalties of up to £7,000 for specific compliance failures. Think about that for a moment. A single administrative mistake, a missed document, a late notice, £7,000. And the rules triggering those fines are not always obvious. Landlords must now provide written tenancy terms within a specified time frame after a tenant moves in. Miss the deadline and the penalty clock starts ticking. Even advertising rules have shifted. Listings that exclude tenants receiving government benefits may now be considered discriminatory. You may think you are simply screening applicants. Regulators may see unlawful discrimination. And here's where it gets disturbing. The law also discourages rent bidding practices, situations where tenants offer more than the listed price to secure a property. Regulators say this protects tenants in tight markets. But for landlords used to flexible pricing, the compliance landscape has changed overnight. One missed rule, one incorrect listing, one delayed document, and the penalty could reach £7,000. You paid for property ownership expecting control and income. You got regulatory exposure. When a paperwork mistake can cost thousands, the promise of simple property investment hits differently. But the financial shock doesn't stop with compliance fines. The second shift is happening quietly through tax policy. For years, landlords were allowed to deduct mortgage interest payments before calculating taxable income. That deduction mattered. It meant landlords were taxed on actual profit rather than gross income. But the rules changed. Under updated tax policy, most individual landlords can no longer deduct mortgage interest in the same way. Instead, many now calculate tax based largely on rental income before interest costs are fully considered. Think about what that means for you if you carry a mortgage. Your tax bill may now be calculated on money you never actually keep. Property investors say the impact has been immediate, especially for smaller landlords with leveraged properties. Profit margins shrink, cash flow tightens, and if interest rates rise, the pressure compounds. Supporters of the policy argue it levels the playing field between landlords and homeowners. Critics say it fundamentally alters the economics of small-scale property investment. You bought a property expecting the tax system to reflect profit. You got taxation based on revenue. When the tax bill arrives before the profit exists, the promise of rental income hits differently. And if you think those changes are severe, what the next regulatory enforcement rule allows authorities to do makes these look minor. The third shock arrives through eviction enforcement, and the penalties here are no longer administrative. They are financial sledgehammers. Under the new framework linked to the Renters' Rights Act, landlords who misrepresent the reason for removing a tenant can face penalties of up to £40,000. Think about that number for a moment. £40,000. The rule targets situations where a landlord evicts a tenant claiming they intend to sell the property or move into it personally, but then rents the property again shortly afterwards. Regulators now have the authority to investigate those cases. If authorities determine the eviction reason was misrepresented, the financial penalty can escalate dramatically. You may believe you're managing your property strategy. The regulator may see unlawful eviction behavior. And here's what they don't tell you. Even legitimate cases can become compliance risks if the timeline changes unexpectedly. A delayed property sale. A change in personal circumstances. A new tenant appearing too soon. The investigation threshold is now far lower than many landlords realize. You paid for property ownership expecting flexibility. You got regulatory surveillance. When one strategic decision can trigger a £40,000 investigation, the promise of landlord control hits differently. But the deeper issue isn't just individual rules, it's the system forming around them. The government is now preparing a national database for private landlords across the United Kingdom. Every landlord will be expected to register. Every property may be recorded. Alongside that database, a new independent ombudsman system is being introduced to resolve disputes between tenants and landlords. On paper, it promises fairness and accountability. But registration failures or refusal to join the dispute system could also trigger financial penalties. Think about the scale. Millions of rental properties, thousands of landlords navigating new compliance systems. One expanding oversight framework. The rental market is no longer just housing, it's becoming a regulated infrastructure. But you don't have to be a victim of this system. And once you understand what's really happening, you become much harder to exploit. The fourth pressure point isn't a fine or a regulation. It's the slow financial squeeze changing who owns Britain's rental homes. And it's happening right now. Over the past decade, tax changes and higher stamp duty rates on buy-to-let purchases have steadily altered the economics of property investment. Landlords buying additional residential property now face significantly higher stamp duty costs compared with standard home buyers. That means thousands of pounds added to the purchase price before a single tenant moves in. You paid for a property expecting long-term investment stability. You got rising acquisition costs and shrinking margins. But here's where the scale becomes impossible to ignore. Housing economists say smaller landlords are increasingly reconsidering whether the numbers still work. Mortgage interest restrictions tighten cash flow. Compliance costs increase. Administrative risks expand. For an individual landlord with one or two properties, those pressures stack quickly. Think about that. Every year, across the entire country, thousands of small landlords reassessing the same calculation. Is the risk worth the return? And while smaller investors face that pressure, another group is quietly expanding. Large financial institutions and investment firms have been steadily increasing their presence in the residential rental sector. Banks, investment funds, and corporate property firms are purchasing entire housing blocks or large portfolios of homes as long-term assets. When smaller landlords exit the market, those properties don't disappear, they change hands. Often to organizations with far greater capital reserves and compliance teams. The friendly local landlord model begins to fade. Corporate ownership rises in its place. You may think the rental market is simply adjusting to new regulations, but the ownership structure of housing is shifting at the same time. And when housing transitions from individual ownership to large financial portfolios, the promise of the traditional private landlord system hits differently. But knowledge changes everything. Stop. Take a breath. Because once you understand exactly how this new housing system works, you become far harder to exploit. Everything you've heard so far, the £7,000 fines, the £40,000 eviction penalties, the tax changes squeezing profit, the growing corporate ownership of housing, follows one simple pattern: complexity. The system becomes complicated enough that ordinary landlords make mistakes, and mistakes trigger penalties. But once you understand the pressure points, you can protect yourself. Housing lawyers quietly call the first strategy documentation defense. It sounds simple, but it protects you from the majority of compliance penalties. Under the new regulatory framework, landlords must provide specific written tenancy information within strict timelines. Miss the deadline, and the financial risk begins. But here's what most property owners don't realize. Regulators typically act only when documentation cannot be produced. If every tenancy agreement, notice, inventory, and communication is stored, time-stamped, and archived, disputes become dramatically easier to resolve. Yet thousands of landlords still rely on scattered emails or paper documents. Why? Because the system never forced them to modernize, until now. The landlords who adapt first avoid the majority of administrative fines. The second protection strategy is what housing advisors call advertising compliance. The rules around tenant selection have changed quietly but dramatically. Property listings that exclude tenants receiving housing benefits can now be interpreted as discriminatory. But many landlords still use old listing templates written years ago. That creates legal exposure before a tenant even views the property. The solution is simple: neutral advertising language that focuses on property criteria rather than tenant characteristics. Regulators look at wording. A single sentence in a listing can determine whether a landlord faces investigation. Think about that. One sentence, one advertisement, potentially thousands in penalties. The landlords who understand that rule early remove risk immediately. The third strategy is financial resilience. Many small landlords built their investments assuming mortgage interest relief would remain unchanged. That assumption no longer holds. Smart investors are restructuring loans, reviewing ownership structures, or building larger cash buffers to absorb tax and interest fluctuations. Why don't most landlords do this? Because many entered the market treating property as passive income. The system now treats it as regulated business activity. The landlords who adjust their financial planning survive the transition. Those who don't face shrinking margins every year. There are also emerging alternatives for investors seeking stability. Institutional build-to-rent developments, professionally managed rental portfolios, and regulated property investment trusts are growing across the UK. These structures operate under transparent governance, long-term financing, and professional compliance teams. They are not immune to market pressures, but they are built to operate within complex regulatory frameworks. That's why pension funds, insurance firms, and investment groups are increasingly entering the housing market through these structures. Here is the reality. The rental market you thought you understood is changing, quietly, systematically, and permanently. Government regulators say the reforms improve tenant protection and fairness. Critics say they place disproportionate pressure on smaller landlords. Both things can be true at the same time. But one fact is unavoidable. The system is becoming more regulated, more monitored, and more financially complex than at any time in recent decades. The government isn't protecting your investment decisions. The tax system isn't simplifying your strategy. And regulators won't prevent costly mistakes. But you can protect yourself. Which housing change shocked you the most? Drop your experience in the comments. And if you want to watch a video like this one, click the video on the screen. Thanks for watching.